Hi, everybody. Welcome to Friday. We're supposed to be having a live Talk Money with Tom show today. We had some technical difficulties, so I did want to put out the summary for this week. I think this week has been kind of important, especially today since we're down a couple percent. We had a great run up at the beginning of the week when there was some supposed flexibility that was going to be happening around some of these tariffs that were due to happen on April 2nd. We're doing okay. And then all of a sudden there was a surprise tariff announcement in the middle of the week here about the automobiles. And the market started to come down. And then, of course, today we had the PCE report that was a little bit higher than expected. So I've got some charts I want to show you, kind of walk you through what I see happening here and kind of what some of the strategies might be, at this point in time with what we know as far as that goes. So I'll share my screen and then we can talk through this. So this is a chart we've been looking at for all of the shows, going back to 2018. You can see, obviously, we've got a situation where, the market has come down so far kind of year to date. And again, this is weekly data. I'll point out some of the things that I think are important about this as far as that goes. But one thing was yesterday I was talking about how, this little uptrend that we had going on from this bounce from the bottom was still intact, even though we had some negative days for a couple of days there. And this is just, here's a shorter view. This is hourly data for the S&P 500, going back a few days here. But here's our low point that we hit, and then we kept hitting higher lows. This is right next to yesterday's close. And of course, today, that broke down. And the reason it broke down is because of the PCE report. So again, this is the core PCE. They take out food and energy. Personal consumption expenditure index is what the Fed looks at. They're trying to get this to 2%. I personally think they're okay with a 2 to 3% range as far as that goes. But if you look, we hit 2.79%, was a little higher than expected. It was supposed to be about 2.7%. So the market didn't like that. What this is year over year. So the February of this year versus February of last year. So, the prices in this basket grew at 2.8%. Now, if you look back all the way here to May, we've had the same essential core PCE between 2.6 and 2.8% roughly since last May. So almost a year now altogether. Again, this is a late view. PCE always comes out at the very end of the month for the month prior. But that wasn't terrible. But what the market's really responding to here is this month over month. And I know this chart looks kind of interesting, like teeth or something like that. But what this is, if you look, I mean, in in November of last year, compared to October of last year, prices in core PCE only went up 0.1%. And then January was 0.2%. December 0.2, January 0.3, and now it's 0.4%. So this growth that's happening right here is worrying the market. And that's because, I mean, if you annualize this out, if you say 0.4 times 12, so if we had 0.4% growth in costs all the way through, you'd be at 4.8%. You're back in an inflationary environment. You're back into a situation where the Federal Reserve is raising rates in that particular situation. So now here's the thing that's interesting. None of this has anything to do with physically the tariffs increasing prices just because the tariffs haven't been out there long enough. What this does look like is the talk about tariffs is creating some inflation. So I think this is important to understand. The Federal Reserve doesn't really talk about these consumer sentiment surveys except for one part. And so a lot of people hype up, how people feel about the economy and such. And I've said several times, these sentiment surveys don't seem to match up with the reality of what people are doing in terms of their spending. But the one part that the Fed does look at is the expectations for future inflation, which have jumped quite dramatically since the election, having to do with the tariffs. And so the talk about tariffs is causing actual inflation. And what's happening and why the Federal Reserve looks at this so closely is because people start to buy things, early. And hey, if it's going to cost more, I'm going to get it before the tariff. And so there starts to be more money being spent for, let's say, the same amount of goods, you're going to get an increase in price. There's more demand. As the supply stays the same, price is going to go up. And so it can kind of be the self-fulfilling prophecy. We haven't actually seen the tariffs impact, like, for example, these tariffs that they're putting into automobiles, anywhere from I've seen estimates from anywhere from $2,000 to $15,000 increase on an average automobile price that could happen fairly quickly, even within a couple of weeks, as far as that goes, as these work their way through. And so, we don't even know if they'll stick around for, forever or how long. And that's what the problem with tariffs is that it's sort of been changing almost on an hourly by hourly basis. And, they could decide to abandon the tariffs for all we know. But at this point in time, the market is looking at that inflation and starting to worry about it as far as that goes. So that's the big drop that's happened here. Is just this, this inflation report that came out today really kind of took us out of our little recovery trend that we were in as far as that goes. Because if you look at it, you could have a situation where tariffs theoretically cause inflation. They also cause slowdown in the economy as people can't afford as much. Sometimes there might be reciprocal tariffs, so you might see some of the exports start to drop off, could lead to layoffs and these types of things. So I think you have to be careful. We don't really know what's going to happen. That's one potential path, but there is enough of that out there that people are starting to become concerned about it. It is affecting kind of what's happening with the stock market. So one other piece that came out from this report today about PCE, they also have an expenditure, so personal monthly spending month over month. And so you can see, actually the average growth in personal spending is about 0.5%. And so they expected about 0.5%, and it was at 0.43. It was some, we missed a little, but actually pretty good. The big concern here was actually what happened with the drop last month. So this would be February 0.43 up, and this is actually down in January. And people were looking at that. My look was that if you look at December, it was much higher than average. It was up 0.86%. And so, it kind of averages out. People spent their money in December. And, January, we often get some weather-related issues and what have you. And you actually had a drop. I don't think that the consumer is backing off quite yet, although it's a little bit lower than average even for this month. So, but I was, this is the first real number. So you get the sentiment that comes out. Now we want to see the real spending numbers. And so this is one of the first ones that comes out. I think this is okay, personally. So, we'll see how that plays out, because in the end, 2/3 of the economy is consumer spending. So what corporations are doing in terms of spending, what consumers are doing in terms of spending is really, really critical as far as that goes. So this is not a bad number as far as that goes. So, all right, so let's look at kind of some of the pieces we look at for change of direction. All right, kind of a checklist of different things that you look for. So this is the S&P 500 for the last year, with using it day by day data to kind of create this line. And the close is a point on the line, and that golden line there is a 50-day moving average, and that blue line is the 200-day moving average. So as a checklist, you would look at that and say, okay, are the lows higher and higher and higher? So if you look, okay, so here's a low, that's higher, that's higher, that's higher, right? That's higher. We finally actually crack that and set a lower low. Okay, so that's one of the pieces that actually comes from Charles Dow, who is the founder of Wall Street Journal, and all of his writings. They ended up putting into something called the Dow theory, and one thing that's part of that is what's called the primary trend. And so primary trend being up as far as that goes, or down. And so are we still in a primary uptrend? Well, one of the pieces is a lower low. And, there's things have been added to it by me, by others, and what have you too. So one of the things I look for is this, is the price above the 50-day moving average? No. Okay. Is the 50-day moving average coming down? Yes. Okay. So this is moving down. Is the price below the 200-day moving average? Yes, it is. Tried to get back up there, but it came below. And so, again, these are pieces of the checklist. So there's a lot of checklists that say, hey, we're starting to change direction, although the more important ones still haven't happened. So second thing you look at is the 200-day moving average going down yet? No, it's still going up. So that's a positive, right, in the trend direction. And then lastly, has the 50-day moving average crossed through from the top the 200-day moving average? And that's what they call the death cross. And so once that happens, you have changed directions. Your primary direction is down. You get through that checklist, your primary direction is down. And so you have to respond to that. We have a different kind of trading system that happens. But if we look back at, the longer term here, okay, so here's, again, that big chart we looked at earlier. Here's our low point, October 13th, 2022. And we've been, running ever since. We had a 10% drop here. We've had a 10% drop here. But the primary direction is still up. especially if that 50-day moving average is over the top. So you should be staying in this particular type of market just because the recovery can be so violent. So once things turned around here, for example, this was in November of 2023, you had almost a 9% month, 8.9% on the S&P 500. If you're off in T-bills or something, you avoided some of this downturn maybe, but you actually probably lost by the time you got back in. So you want to be careful of these short moves because they can very violently turn around. In this environment, you could have a situation where different things are happening with tariffs that the market looks at as positive. It could be tax cuts. It could be some kind of announcement to make that work. So, we'll have to see how that plays out. Maybe it doesn't happen. And then you want to be, moving into more conservative areas, especially if you have a primary direction change. Now, one of the things that you want to do right now is figure out what's working. So you should have, in our opinion, a majority, like say 3/4 of your portfolio, kind of the broad-based indexes, both the bond and the stock, and kind of ride through these things. And this is part of the methodology to figure out what risk level you should be taking and how much you should have of stock and bond and et cetera. But you want to be in a broad basis for the most part, and then maybe you have some target pieces, which is what we do for some of the other portions, where you try to rotate into things that are moving well. And so I've got this chart. I've shown this chart before. I know it's kind of messy, but if you look here, the S&P 500, last 30 days is down 4.75%. All right. T-bills are the next one here. They're up 0.34%. So it could have been in T-bills, would have made more money. But if the market turns around and you have a big month like we did in November of 2023, you're going to lose big time. I mean, you might make 0.3% when the market makes 9. So you kind of want to stay in there with something that is kind of moving right now. And so if you look at what's doing better than T-bills, for example, it's international. VXUS is a Vanguard total international stock. So this is essentially all of the international stocks that are liquid enough to be in this. I think there's a huge number of stocks in this particular ETF. It's up 0.72, better than the T-bill. If the market turns around, I would guess that the S&P 500 is probably going to outdo the international in that time frame, but the international will definitely be outdoing the T-bills. So you want to be in there to capture at least some of that gain. Next one up here is utilities, XLU, which is the State Street Utilities. These are utility companies out of the S&P 500. BEA, this is a Vanguard Developed Markets. So this is, big countries outside the U.S. VGK is the Europe. All right, so that's up 2% in the last 30 days. And if you want to add more risk to your portfolio, you got energy, which is XLE. These are the energy companies put out by State Street Spider ETF that includes the energy companies from the S&P 500. It's up 3.76. And then GLD is actual gold, right, up 7.16. We don't use these much in the portfolio just because they have such a volatile nature and just, we're a bit more conservative than that. But just to show you, what's out there and what's happening and kind of how you want to maybe deal with this particular situation. So even though the market is struggling, is down today, our primary direction is still up, right? So if I go back here, even though that looks like, we're changing directions, it looked like that here, so it's hard to tell for sure. There is a lot of momentum. Earnings are still pretty great. Mainly this is driven on a non-fundamental basis in the sense of 2000. This was inflation, right? Market drops 28% because the Fed raised rates over 5%. That's pretty straightforward. Here's a pandemic, right? Shut down the entire world. 35% drop really fast. That makes sense, right? And so if you look at like 2008, it was structural. Hey, we lent everybody under the sun money to buy a house, even if they couldn't afford it. And, that kind of imploded on us. Here, it is essentially an administration deciding to do tariffs, and, they could change their mind and decide not to do tariffs. So you have to keep that in mind. Ultimately, if you keep going and you keep having problems and you keep having, consumer sentiment surveys that are negative and people will stop spending, you're going to get a recession and, you'll actually have a structural issue that just can't be turned off right away. But we're right now in an area where this could be turned off tomorrow. I don't feel like it will be, but I also don't know for sure that the market is going to respond negatively to it all the way through. I mean, so here's 2018. That was the last time we did big tariffs, $350 billion worth of tariffs, right? Market dropped 19.6%. They stopped doing tariffs. Market came back pretty quickly. We actually had a pretty good run going up until the pandemic after that too. So that's, again, we just kind of have to wait out there and see what's going to happen, rotate into some of those things that might be doing a little bit better than a T-bill and what have you, and kind of see if you can ride some of that momentum and wait and see what happens. Now, again, we look at the bond market in the same way, primary direction, and all these things that happen. And I mainly talk about the stock market, but the bond market is actually going up quite a bit right now, just because of the fear of higher inflation and the tariffs maybe causing some type of economic slowdown. We'll see how that goes, but anyway, that's our kind of summary for the week. Again, sorry we couldn't do the show today, but I did want to get this summary out. So thank you for bearing with me. I look forward to being able to talk to you again about this on Monday. Thank you.